And I also think it's kind of funny that we've built these open ledger systems, but nobody can seem to agree on any of the analytics. So what we want to do is, building on open standards that people can audit and understand easily, and taking away all of the kind of data engineering challenges around big data from the chain. And then also making that really easily accessible using AI, so that you don't necessarily need to be a shadowy supercoder just to get some interesting data out of the chain. You could be someone like me who, my background is I'm not a developer. Right? I can write a bit of code, but I would not class myself as a software engineer or anything like that. And until not that long ago, I'd never wrote any SQL in my life. And yet I'm able to explore all of these insights. The background I'm bringing to that is someone who's got a lot of experience with DeFi, who understands the protocols, understand what's important and like what I want to know from the chain, less so how I get it, right? And what we're trying to do is abstract away all of those technical challenges around how you get it, and just make it easy for people to get the data, do whatever analysis they want, and then also to be able to have that data in real time, right? So these are not just like static queries, but that you could actually build real-time dashboards or stream that data into your front end for your DApp. So yeah, that's a bit about Pangaea and what we've been up to.
Absolutely. And you've been making quite a mark in that you basically have been releasing some reports recently, some of which, one of the things we like to do is we like to just kind of go through the top stories on Leviathan news for the past week. And one of the ones that popped out was this one, which really made quite, this was a study that found that for every dollar of yield basis trades, of course, yield basis is super new. It's only been around for a couple of weeks. But based on this early data, you found that for every dollar of trades, it generated $1.09 of volume on Curve due to these swaps. And this is, in fact, where Second Set Maze suggested that we connect. So to pull this article up, let me head to this blog here. Why don't you walk us through this particular data? Because it's just such a fascinating research report. Here.
So the initial motivation for this came from Mitch's first proposal to the Curve DAO for a credit line of Curve USD to kick everything off with yield basis. So the Curve USD is being provided without borrowing charges to the Curve DAO. So there needs to be something in it for Curve, right, to issue this credit. And there was a few proposals as to what the benefit of yield basis for Curve is going to be. Firstly, Curve is going to get an allocation of yield basis tokens. That's great. Secondly, was that it's going to increase the Curve USD circulating supply and act as a supply sink for Curve USD. And the third one is that Curve will pick up extra volume from routing yield basis trades, because every swap on yield basis is going to have to go through Curve USD because they're all Curve USD pairs. And most of the arbitrage traders are not holding Curve USD as inventory. So let's say they're holding USDC and they want to do an arbitrage on one of these Bitcoin wrappers. They need to swap their USDC to Curve USD so that they can then swap in the yield basis pool. And that swap for USDC to Curve USD is going to go through one of the Curve pools. So that creates volume in a Curve pool equivalent to the volume traded on yield basis. And so the initial prediction was that the volume should be 1-for-1 pretty much. So for every $1 being traded on yield basis, we would expect $1 being traded on Curve, and that's incremental volume for Curve, which of course it's earning fees on. So that was the hypothesis. Yield basis launched, it's about 2 weeks ago now. And so we just wanted to investigate, does this actually hold true? You know, given the limited data that we have from 2 weeks of it running, do we start to see indications that this is in fact the case?
Right. And to be clear, this is based on the period where there was at first just $1 million in each of the Curve yield basis pools, and then the credit line got increased to $10 million per pool, so a total of 30 million. And you can see on the chart here where the red line changed. There was no difference between the kind of first phase where there's just $1 million and the second phase where there was 10 million per pool.
In terms of the volume for Curve?
Yeah, in terms of the stats that you found, that's $0.09 marker that was consistent, or was it kind of?
I don't think I actually detailed it here, but if you look at the chart below this, if you scroll down a bit. So here, yeah. So this is the chart that shows how much associated volume yield basis generates for Curve here being the green line. And one thing that was notable, and I think we might need more data as yield basis scales to really prove this out, is that there are some economies of scale which mean that the associated volume on Curve may actually end up being higher the more volume that goes through yield basis. The reason being that like gas costs are a fixed cost on a trade. So if the size of those trades is very small, then you want to avoid routing through lots of different pools, because each one that you're routing through is going to increase the gas cost of that transaction. So if it's $100 trade, you know, you don't really want to do lots of routing, even if there is some cheaper prices that you could have got. It's not going to be profitable. But if that trade is like $100,000, then the incremental gas cost on routing through those pools is justified by the extra arbitrage that you're going to make in doing so. So I do think there's reason to believe that there's an economy of scale at play there, where we might see more routing as the size of trades scale up. But yeah, what we're looking at here is the volume that we can attribute to yield basis. So here I'd like to discuss the methodology, because I think it's quite important to say, what do we mean by attributable volume? As I was getting ready to publish this, I think the day before, Benny shared some stats, some analysis that he'd done. And there the methodology was quite different. So there it was looking at all of the transactions that have a yield basis swap in them, and then saying, okay, in those transactions, how much volume was there on Curve as well? And yeah, you've got the post here, right? It was really encouraging to see this, because it was nice to see, okay, someone's thinking along exactly the same lines. But the methodology I've used is quite different, and it's actually much stricter than this. So for example, here you can see there's a dot above $1 million, right? That's lining up with a yield basis trade that's less than 10K. And my take on this is that it's overestimating how much Curve volume is generated, because you're looking at all of the trades on Curve that are in the same transaction, but not all of those Curve swaps are necessarily associated with that yield basis swap. They might just so happen to be in the same transaction. So now, because of like batch transactions, like from CowSwap and things like that, they might be solving swaps for 5 different users, and these are all taking different routes. And maybe only one of those is actually going through yield basis. But if you measure all of the volume in the transaction, it's going to capture all of them as if they were all related to this one yield basis swap. So we need to parse out what is actually related to the yield basis swap and what is unrelated. So that's what our flow analysis methodology aims to do. And it's quite strict in how it does this, but essentially, suppose you have a $10,000 swap on yield basis. We then say, okay, there's a $10,000 budget, and either side of that trade, so upstream and downstream, we can match that with another swap, let's say on Curve, up to that amount. So we say there was this $10,000 swap before the $10,000 swap on yield basis. We can directly attribute that volume to what happened on yield basis. So we count 10K there. But the other thing is we want to capture multi-hops, because you could route through several different pools, right? So maybe someone swaps 10K of SUSD to USDT, and then they swap 10K of USDT to USDC, and then they swap that 10K through yield basis. Well, now we've got 2 10K swaps, so we're saying there was 10K of volume on yield basis and 20K of volume on Curve that's associated with that trade. And also note that it can be upstream or downstream. So they could have swapped on Curve before yield basis, and they could swap after. And that's why you can end up having the associated volume actually be higher than what's on yield basis.
So that all makes perfect sense. But the way I'm reading this chart is that the biggest winner is actually Uniswap.
So that, I think, is the incorrect conclusion to draw from the data. So you're right. We also included Uniswap in the analysis because we felt it was good to provide some comparison. And also we wanted to understand better where the flows that weren't going through Curve are going. That was the reasoning for including Uniswap. And we see here in the chart that the attributable volume from the yield basis swaps is higher for Uniswap. But the reason why I think it's wrong to draw the conclusion that yield basis benefits Curve more, there is at least 2 reasons. So the first one is it's unsurprising that we see a higher associated volume, given that Uniswap in general has much higher volumes than Curve. So if we think, most of the swaps going on in the world of DeFi are on Uniswap, and there's a lot of routing through Uniswap in general, it's not surprising that we see that lots of the stuff going to yield basis also gets routed through Uniswap. What's remarkable is actually how high the associated volumes are on Curve relative to Uniswap when you compare that overall market share, like outside of this analysis. So for example, in September, Uniswap's DEX volume in September was $53.78 billion, whereas Curve's was $8.3 billion. So Uniswap has, in general, a much higher ratio of swap volume to Curve. And yet within this data set, we see like Curve having an outsized share of the swap volume. So that's the first point I would make about this, is that yeah, Curve's contribution here is outsized relative to its general market share for volume. And the second point I would make here is that we're looking at the added associated volume for Uniswap, but what we're not factoring in is whether Uniswap is losing volume on the BTC pairs. So I think that we need some more time and more data before we see really what is the impact of yield basis on competing DEX's volumes. But if yield basis is very successful and ends up doing a lot of volume for BTC USD pairs, then we might expect that the competitors are losing market share on those pairs. And so, okay, there might be some volume gained in some places, but some volume lost in other places, and potentially on net, it's a net negative for Uniswap. Whereas for Curve, because the speciality for Curve has not so much been focused around volatile pairs, it's been around the stable pairs. What Curve might lose in BTC USD volume, for example, from the tri-crypto pools, I think is far outweighed by what it would gain from the stable swap volume. Does that make sense?
It does. You might have noticed I disappeared briefly, and take no offense, it was my laptop kicking me out. I was fascinated, but it makes perfect sense. And yeah, I do think I'm among the people that think that this is like a clear win. So like for my sake, I've been watching some of these transactions going through and really just marveling. So here, like I'm bringing up the Curve interface showing off the yield basis CBTC, WBTC, and TBTC volumes. And we've really seen a lot of interesting swap activity. You mentioned some of it where you see very high volume trades, very high amount, and not really seeing much in the way of slippage. And this is off of just very small 20 million TVLs, or even the 3 million TVLs. It was able to accommodate some like very big trading activity. And these base VAPYs, like between 8 to 10%. Now, yes, Bitcoin's been a little bit volatile in the past week, but that's just remarkable. Like, isn't that everything that was pitched was kind of high single-digit to low double-digit yields on Bitcoin?
Yeah, so we can ask, like, why are these pools efficient, right? Given that they're not that deep currently because of the caps, so why are they capturing this volume? And we published a post about this on the Pangaea account the other day about the refueling concept. That is a novel innovation in the new to crypto pool. So I really find this fascinating, and it was interesting to dive into the data because it's something, until I really looked at it, I didn't even fully understand too well. So I think it does need a bit of education on this. But the short answer of why the liquidity is being utilized so effectively is because it's well concentrated around where the current price is. So if we imagine, let's say it's Uniswap V2, just your basic AMM formula, and say you've got 100 million in the pool. Well, only a very small portion of that 100 million of liquidity is actually being utilized by the swaps at the current marginal price. And that's why Uniswap V2 is quite inefficient for these like high volume, deep liquidity pairs. So, we have some innovations on that. We have Uniswap V3, which is cool because it allows us to concentrate liquidity around the price much better, so that we're actually utilizing more of the total liquidity that's in that pool. But one of the downsides of UniV3 is that concentrated liquidity needs to be manually managed. I think if you scroll down a little bit on this post, I have a nice GIF that I made this years ago, and I was quite pleased that I had a chance to post it. But what you can see there is the concentrated liquidity moving around, right, as the price moves around. So where we see the peak of that concentrated liquidity, that's generally where people are swapping, right? But what you'll notice is it doesn't all go where the current price goes. And that's for a few reasons. First of all, it actually takes some effort. You actually have to go and make a transaction to move that liquidity. But also doing so is going to cost you gas, and you're going to realize impermanent loss. So that's the first learning, is there is a cost to moving liquidity. And because of that, a lot of the liquidity can end up being idle. It's not actively being utilized around where the current swap price is. So the Curve crypto swap pools, you think about the previous iterations of these, what they're aiming to do is to concentrate the liquidity around the current price, and instead of relying on people manually moving those positions, to automate moving it around the current price. So that's good because it's automated, but it is still incurring this cost, this rebalancing cost for the LPs. So you don't want to move it around too much, otherwise you're incurring too much cost for the LPs. So it's a bit of a trade-off. The innovation that the new 2Crypto implementation brings is this refueling. So the concept here is, let's have a pot of money on the side, and when we need to move that liquidity, let's basically subsidize moving that, the cost of moving it, with this refueling pot of money. And this means that, like, we can better keep the liquidity concentrated exactly around the price that people want to swap in, which means that you're utilizing the liquidity far better. Therefore, you can offer people a lowest, like more efficient pricing with less total liquidity in the pool. You're doing more with less, basically. And then the question is, well, okay, who's gonna pay for this refueling? Where does this pot of money actually come from? In yield basis, it's very smart, because the pools, they have this borrowed Curve USD, and that is charging an interest rate on the borrowed Curve USD. But instead of the protocol pocketing that money, which would be the short-sighted thing to do, it's keeping it aside and using it as this refueling budget to pay for the rebalancing, which is supercharging the efficiency of the pool. And that's ultimately going to be, you know, a bigger win for everyone, because it's going to mean that there's more swap volume, these pools are going to grow even more. So yeah, it's all down to new implementation of 2Crypto. And what's going to be really cool to see is that yield basis is like pioneering the new implementation, but soon we're going to see the new 2Crypto on Curve as well. And it's been hinted at that this is going to be for foreign exchange pools, which will be very interesting to see.
Yeah, very much so. And I don't mean to interrupt you, but I just did change the graphic because there is just 2 minutes left if you're interested in bidding for the Squid Pass, by the way. So the Squid Pass will get you the advertising inventory, that QR code in the upper left corner, as well as featured placement on the website, in Telegram, and on our X channel. So it's a pretty good deal. We'll show you why a little bit later after Joe has to run to the airport. But we'll keep this up as we continue to discuss the FX swap pools, just to see if any bids do come in. So I think the other thing that you might think about when you talk about these FX swap pools is that, we saw the stats on the yield basis pools earlier, and they are like doing 10%, give or take, virtual trading APY. Now, ordinarily, the solution to impermanent loss in the pools is that you subsidize trade LPs in the pool by giving out emissions. So like you might like take USDC or Curve USD or Bitcoin or just whatever Curve token, stream it to the pool, and you might need to give traders or LPs, sorry, 15% to be willing to sit in that pool. And at the same time, they would get like just a very small amount of like trading fees back. But in this, like, because you're actually taking the money you might have spent on incentivizing the pool and using it to incentivize the ability to basically supercharge the trading, you might actually end up spending less in terms of the refueling or top-up costs, but you would actually get more of a comfy position for LPs because they're going to get such a higher trading volume. Is that correct?
That's the idea. Yeah. Net, it's a good investment, right? And just to comment on this, like, I think we need to realize how much of a big deal this is going to be for the whole of DeFi if we can seriously mitigate impermanent loss. Because right now it's a massive constraint on liquidity for key pairs in DeFi. The reality is that in many cases, the token incentives and the natural swap fees are not enough to outweigh the impermanent loss that LPs are suffering. And so it's just not adding up. It's not making enough sense for like serious amounts of capital to start coming on chain and deploying into deep DEX pools. And that's what we need to be competitive with centralized exchanges, so that we can actually have price discovery for major crypto tokens happening in DeFi, not happening on the centralized exchange, where then the only point that DeFi serves is just to arbitrage between the exchanges, right? But we want the price discovery and like the primary trading activity to happen in DeFi. The only way we're going to get there is if it can be really attractive to provide liquidity in DeFi. And the only way that we get to that is if we can mitigate or even eliminate impermanent loss. So this is a really important test and is going to unlock like a new level of scale for DeFi if it proves to be effective.
Yeah, and when you talk about foreign exchange, like it's you could see there's a lot of comments that have been streaming in if you're watching the comments, because there's talk about like, yes, we could do this with gold. Forex could be a really big opportunity. But to date, there hasn't really been a huge amount of demand for non-USD based stablecoins. I'll have a chart I'm trying to pull out somewhere, but it's basically like 99.8% of all stablecoins are denominated in USD. And there's many reasons for that. But do you suspect that actually this could be the catalyst that unlocks non-USD stablecoins? Because if there is an efficient place for central banks, for example, to park their coins in LP and put it up for DEX liquidity on chain, like this actually could lead to such a flow of stable coins, not USD stable coins.
My take on this question is it's going to be a necessary but not sufficient condition for that to happen. Okay. So it's necessary that the swaps are efficient enough that we can actually do high volume Forex trading. But there has to be some demand to do high volume Forex trading for that to actually happen, right? And in order for us to have that demand, people need to be at one time wanting to hold one stable coin and then at another time holding another fiat stable coin, right? And right now, I don't see that. And the missing piece I see is the on-off ramp. That's what I think is going to be the catalyst for seeing a Cambrian explosion of fiat-pegged stable coins that are non-USD. If you think, for example, the Great British Pound, there's really little value to me holding any Great British Pound stable coin because I can't use it to like directly cash out into my bank. And also I can't on-ramp directly into that. So I'm not going to be like, maybe I most of the time hold USDC, but then when I want to cash out, I want to cash out by swapping into this GBP stablecoin. So I make that swap, and that's creating some good volume for that pool, is all the people like me doing this. But right now I don't have that off ramp, so there's almost never really a case for me holding this. In the absence of on-off ramps, the one case I can see for the non USD stablecoins is where you think that you want to hold a stronger currency. So like there is Swiss franc stable coins. I think Frankencoin has a Swiss franc stable coin. And that's quite cool because we know that the dollar has been down only since Trump got in office, right? By design. So yeah, you might want to hold the CHF stable coin, but I can't actually cash out into that, right? So that might make sense for some of the stronger currencies, but for weak currencies, there's basically no reason for me to swap into that until we can have a smooth on-off ramp. What I've seen with Monerium and I can't remember what it's called, Euro C, I think. There are some Euro stable coins that do have this kind of direct on-off ramping into a bank or spending on Gnosis Pay. And that's really positive. That's what I think we need more of, because then it actually gives people a reason to swap into them. Then we'll see some volume in these pools. And if those pools are efficient, then we have all the necessary and sufficient conditions for good Forex on chain.
Now, I will just push back and say that I think in the past like 24 hours or so, the dollar up in value. But yes, it's been down only. But I'm a burger, so I don't pay any attention to anything except for dollars and all my crypto tokens. But
yeah, well, it's still down like 99.999% against Bitcoin.
So just to bring this back to the kind of curve thing. So let me pop open. There's a proposal here, which looks like it's going to pass. So there's not necessarily a lot of drama. We are still like very, very shy of quorum by a smidgen. So maybe people watching this live stream might be the the like either tip this over the edge or like mound a like really like intense campaign against. Based on what you're seeing, like is it safe to say that you're like endorsing this proposal? You think it's a good idea? We should jump up to 300 million Curve USD?
I think it's been proven that at least on the volume side, the expectation is matching reality and in many ways exceeding reality, right? So Egarov's original prediction was Curve is going to get 1-1 equivalent swap volume. What our research has shown is it's like $1.09. And also that's a lower bound, right? Our methodology is quite strict. We didn't want to like overstate the case. So that's kind of a minimum that you could attribute. So it seems like it's exceeding expectations there. I think things that the Curve DAO should be scrutinizing, looking into more, is what is the effect of having all of this issued Curve USD on the Curve USD stability. That's something I think needs to be monitored, whether there are any like unintended secondary effects of having all of this Curve USD that's been issued, but that doesn't have a borrow rate against it. Because one of the things that Curve USD, one of the levers that it has to maintain its stability is a variable borrow rate. So in this case, there is no borrow rate there, so that's not a lever you can pull. In theory, this shouldn't matter too much because the amount of the Curve USD, it shouldn't basically be leaking out from yield basis, right? It's kind of within the system. But from what I understand, during rebalances, there can be some effect on the peg. So this is something I would suggest like needs to be monitored carefully as it scales. Let's not just shoot straight up to 2 billion.
Yeah, you can see here the CoinGecko chart of the Curve USD market cap, and you notice that just goes vertical by about 30 million correspond with like the most recent yield basis rises. Now, I am not great at reading the charts. Let's see, like here we go. Here's the past month. And you can see that the price, like to my like untrained eye, like it looks like it's mostly, of course it's holding stable, but it does look like it's maybe slightly more volatile since that big dip. Am I like, have you done any preliminary analysis on this or anything?
Not enough to draw any strong conclusions. And one of the things about yield basis is it's a system that is going to work effectively at scale. So this is, it's a bit of a risk, right? But it's like we kind of need to see yield basis scale up to deeper pools and have more history until we can draw any clear conclusions about these things. With small depth, it's not, I think someone gave the analogy the other day of like driving a Ferrari at 5 miles an hour and wondering why you're not getting an optimal experience. It's like it's not built for driving 5 miles an hour. Similarly here, these pools, the system is built to be very large, but we need to see what is the effect of that scaling. And with the Curve USD supply specifically, the main thing is not so much the net number, but what is the proportion of the Curve USD circulating supply that is in yield basis as opposed to not in yield basis, right? So, for example, I'm not sure you had the graph there, but what is the current market cap of Curve USD in total?
So pulling it back up, it is about 175 million.
Yeah. So, for example, if you propose, let's add 175 million into your basis, well, that's a 2x of the total supply, right? So you would want to look carefully at the impact of that. Of course, the other like tail risk is about hacks and stuff.
Right, but I think we kind of have to put that aside a little bit because it's like if it's hacked, there's nothing you can do, and obviously no one wants it to be hacked, and they are doing everything they can to get it super audited. And Mitch is a good coder, but yeah, hacks.
Yeah, so with like you say, like with hacks, all you can do there is try and mitigate the risk as much as possible through lots of auditing, and that has been done, which is good to see. Whereas with these, like the tuning of parameters and stuff, it is something that we can actively monitor and research with the data. So it's like an ongoing emerging picture, and these are complex systems. There's lots of different dynamics at play, and we need to monitor it closely as it evolves, and that's what we'll be doing at Pangaea.
Are there other unforeseen effects that you imagine could come about if we do see Curve USD pass like 1 billion or 5 billion or 10 billion or something crazy, and most of that is in yield basis?
I'm not sure, but there are other like potential dynamics that might play out that could affect these benefits to Curve that were part of our research, right? And these were actually raised on the initial proposal, and I do think they're plausible and something I will be monitoring. So one of the suggestions is, okay, a lot of this volume that's being picked up by Curve is from arbitrage traders who are entering or exiting their trade from USDC, and they therefore need to swap through the Curve USD pools in order to get into yield basis. But what if those arbitrage traders, instead of holding USDC in their inventory, they just hold a bit of Curve USD in their inventory? So now they don't have to incur that extra leg of the trade. They don't have to pay those fees to swapping through those pools. Given that most of the volume here is from that leg of the trade, could arbitrage traders adopting Curve USD as part of their inventory evaporate those extra volumes. That's one risk, right? And I've thought about this a little bit, and on the positive side, I thought, well, wouldn't that kind of be a good thing? Because A, it would signify a lot of trust in the peg stability of CurveUSD. If they do decide to actually hold that in their inventory, that would be a positive sign. And maybe also it would be a bit of a supply sink if these traders are now holding, a couple of million. But when you think about it, like, you don't actually need to hold too much CurveUSD. You don't need to hold like 10 million CurveUSD if most of the trades you're doing are 100K. Maybe you only need to hold like 1 million. So yeah, there's a bit of supply sink there, but maybe not enough to outweigh the loss of volumes. And the other thing that's been suggested is, well, if there's all this volume being created for CurveUSD pairs, won't we see other DEXs start to set up their own CurveUSD pools and compete on the fees for those pools? So it will just be a race to the bottom on fees for CurveUSD pools. I think that's plausible. I don't see why that won't happen, but I also don't see that that's really that catastrophic. I mean, firstly, there's reason to believe that the stable swap pools are generally quite efficient, so there's a little bit of edge there. But even if it ends up being a race to the bottom, the secondary effect of that is that these other DEXs are just creating a big supply sink for CurveUSD because they have to hold that liquidity, right? And all CurveUSD ultimately enters circulation by being borrowed. So they're acting as a supply sink for CurveUSD. That supports the peg of CurveUSD. When CurveUSD is on peg, the borrowing rate can be lower. That encourages more borrowing and therefore overall scales the supply of CurveUSD. So it could be quite positive for the long-term growth. And where I think Curve has actually been quite smart is in recognizing that the DEX fees is not necessarily where the big money is to be made. The big money is to be made on the lending business. And the DEX is, in a way, just a piece of infrastructure to facilitate that lending business. So that's what I think would be like, the 4D chess big brain outcome there would be, okay, yes, there's this competition on the DEX side, but it ends up as a secondary effect supporting the lending business, and that's where more money is to be made from scaling. But those are two dynamics that may play out that I will be watching for.
Yeah, it's very interesting to hear all this. So like I've been getting so many DMs from people and messages asking if what does this all mean? Is it like yield basis trying to like steal all the value and extract it from Curve and send it to yield basis? Is Michael not focusing enough on Curve? And it's kind of silly to me because like I have like a bit more perspective on Curve, so I get to see how like insanely involved Michael is with Curve. But from your position as kind of an outsider, or not, I wouldn't say outsider, but just as a neutral observer, like you highlighted how there's essentially three benefits that yield basis could deliver to Curve. Do you think, in balance from what you're seeing so far, it's a good trade?
Yeah, our article closes by saying that yield basis appears to be highly complementary to Curve. And where I think the complementary aspect is that Curve historically has been focused and has excelled in stable swap, whereas yield basis is aiming to exploit the volatile market segment. So that is not in a direct competition with Curve. That is more directly competing with the market share of a Uniswap, right? That has historically been more focused around the volatile pairs. That's why when you asked, is the net beneficiary here Uniswap? I think that's the incorrect conclusion to draw, is because if it's successful, it's going to end up taking away volume from Uniswap on the volatile pairs and adding volume to Curve on the stable swap pairs.
Yeah, your article very good job of laying it all out. I just wanted to hear it and get it so we could clip it and be able to like flood this everywhere because it's a very good point. A couple of quick lightning round to cover some of the questions that we got. There's a question from arisu.eth. Arisu.eth, my mistake. Yes, the peg keeper is still a thing. You can go check out the curve peg stability reserves at any point. The peg keepers are still authorized to just print in certain circumstances. You can see at the moment, Frax USD has a 3 million debt ceiling and has issued 69 memetically significant number K against that. So you do see that comes here or there.
So peg keeper, intention of the peg keeper is to, well, help CurveUSD stay on peg. The way that it does that is if CurveUSD overpegs, then they can mint CurveUSD into these pairs up to certain specified limits, which effectively is creating sell pressure on CurveUSD and bringing the price back down towards 1. The peg keepers, when they do that, they accrue this debt right up to that ceiling, and then if CurveUSD is dropping below its peg, they can deploy that debt by burning the CurveUSD, and that has the opposite effect, right, of dragging the price up. So it's kind of healthy when the peg keepers, like, they have some debt and then it depegs a little bit, but it's okay because the peg keepers can burn that CurveUSD and offset it. When the peg keepers are all emptied out, if it's still depegging to the downside, the next layer of protection is you start ramping up the interest rates. And that then encourages the borrowers to start repaying their loans, and that fixes it that way. So I think that the concern there would be, well, if there is no variable interest rate on this CurveUSD supply, then you don't have that second lever of variable interest rates.
Very well spoken. You're not only are you like much more articulate than me, but you have that like gorgeous British accent when you say it. So it sounds like very sophisticated. I wanted to bring this chart back up just as kind of part of the lightning round. Correct me if I'm wrong, but this kind of step function that you're seeing in these in this chart here, and this is the chart of the refueling. That step function, basically, like every time there is a kind of refueling, it causes liquidity to be shifted closer to the Oracle price, correct?
Yes.
That's why you see those steps.
And the reason why you see the steps congregated around them is because when there is activity in the pool, or in the price of Bitcoin, that's when the refueling is kicking in. So if there's not really much going on with the price of Bitcoin, there's not a lot of swap activity in these pools, the Oracle price hasn't moved very far from where it is currently, there's no need to refuel.
Yeah, I'm changing it so you can see the legend. And I've been corrected as usual. It's a Mancunian accent, I guess.
It is Mancunian, yes. We're from the north, right? So yeah, it's quite surprising and complimentary to hear that it's a gorgeous British accent. It's certainly not the Queen's English.
I didn't realize it's like some kind of Cockney or Pidgin dialect.
No, far from it. Far from it, Garrett. It's from the north, right? From Manchester.
Okay. I've not visited London, or I flew through the UK like very briefly for a few hours at the airport and stopped to get a sandwich. But I have like almost no experience in London. That makes me very sad.
I'll tell you the difference. In the south, they say that they're going to run a bath, and in the north, we say we're going to run a bath. They say, well, they're going to run very fast, and we say you're going to run very fast.
Okay, all right. Well, I barely speak English, American English at that. So like getting me to distinguish the fine shades of this is going to be probably a bridge too far for me. Alice is also pointing out that variable interest rate is not as effective for peg stability as special liquidation, though. So some shots getting fired.
What was that, sorry? Variable interest rate not as effective for peg stability. What is special
James,
liquidation?
I'm not sure exactly what Alice is referring to. Hopefully, drop some more comments. But it could just be like the harder liquidation mechanisms.
Mm-hmm. Well, that's one way to repay debts.
Exactly. Just yeah. No holds barred. Here's another good one. I was a fan of this one. This is your pinned tweet. But Schopenhauer, you comment, is writing several volumes proving happiness is impossible, and then wrote basically a self-help book, and did very, very well. And basically takes this as the advice is that the person who writes for fools is always sure of a large audience. So
this is
why are you like doing
about, this was not a comment about crypto Twitter KOLs, believe it or not.
I was going to say, why are you writing these brilliant research reports when you could just be talking about meme coins?
I was very surprised that it's got such a large audience. I mean, that's actually quite heartwarming and endearing to me. Like, it gives me some faith in this space that, you know, like a 3,000 word like quantitative research article can actually receive such a large audience. It's quite nice. But my background, by the way, before delving into DeFi was philosophy.
I wouldn't have guessed from the Schopenhauer reference.
Yeah, so and I'm a big fan of Schopenhauer.
No, never could have guessed. No, that's very cool. Alice has chimed in to say that we've seen moments where people are paying 20% to profit from soft liquidation. So I guess the point being that if there's hard liquidation, then people are like more like afraid of getting liquidated, so they're not going to like rush to close their loans. They'll just take the kind of short-term hit, which makes sense.
One by the way, thing we haven't mentioned, which I think could be a very interesting development of yield basis scaling, is the ability to use yield basis LP tokens as collateral.
That's true.
From my point of view, yield basis LP tokens are like the ultimate collateral, because basically it's yield bearing Bitcoin. It has the value of a Bitcoin. It doesn't have the impermanent loss aspect, right? But the underlying value is accruing all of these trading fees. So like we have wrapped stETH, and we've seen wrapped stETH be pretty effective collateral. People like using that because they can borrow against it. The volatility is not as high as some tokens, but they're earning yield on the underlying. But wouldn't that be great if we could do that with Bitcoin? And I also think it unlocks like certain other use cases. So, for example, FX protocol, they allow you to have this system where you're not paying funding fees on your trades because all of the underlying collateral is wrapped stETH, which is earning the protocol some interest, right? But obviously Bitcoin itself, wrapped Bitcoin, isn't earning any interest, so it doesn't have that property. But if you have this yield-bearing form of Bitcoin, then maybe you could do something similar with that. So I don't know what the risks are of using yield basis LP tokens as collateral. I'm sure there are risks, but I think this could be a very interesting development.
Yeah, shame on us for sitting here talking about like the underlying mechanics of how this works, when all people care about is win token. Like YB had their like very successful, like super oversubscribed fund round raise. We barely talked about the effect of the YB token on things, because Curve, like one of the things Curve gets is a like healthy stream of these YB tokens.
Well, there's a vote right now to add gauges on the YB pools, so maybe that means we'll see those tokens streaming fairly soon.
Yeah, I'll get that up, but according to the proposal, that's the final step before it becomes. Oh, I see. It's just sitting in the hopper. Okay, just sent that through. That's the final step before the YB token can go live. So it might be very, very soon. TM.
Yeah, well, we're watching all the contracts, including the gauges. So we will be the first to know when some tokens enter those gauges.
Well, it's passing with overwhelming support, which is perhaps not a big surprise.
Give tokens.
All right. Anything else that you want to chat about while we're on the subject of your research? Anything that you want to plug or anywhere that you want to point people to find you?
Yeah, I mean, people can find me on Twitter at JoeWait Official, and they should definitely follow the Pangaea Twitter account, which is at InPangaea. We will be continuing to drop alpha from there. So do subscribe if you want the alpha. We have a lot of interesting data sets that I've been doing some analysis on. We've also recently published on Aave. We've done some deep dives into Aave, who Aave's users are. Also a very interesting piece about liquidations on Aave. Who are Aave's liquidators? What kind of money are they making? Who is being liquidated and on what collateral? So that's another area we've been looking into. We also have a lot of good data from Curve, so expect to see more pieces diving into Curve, and of course yield basis as that develops. Yeah, this is our blog, right? So we have a good piece there about the DeFi heat index. I think people might be interested to read that. This is a kind of new measure that I cooked up. If you scroll down a bit, I'll give you a little explainer on this. A bit further. Keep going. Yeah, here we go. Go up to that one, the last chart. So what I looked at is borrowing rates on Aave's USDC market, which is kind of becoming DeFi's risk-free rate. If you think about the risk-free rate in traditional finance, it's like the treasury bill rate. And this is the hurdle that you need to meet, right? As an asset manager, if you're not making me the risk-free rate, why am I giving you my money? Why am I investing in these risky assets when I could just be earning 5% on treasury bills, right? And I think we're seeing the emergence of a similar phenomenon on chain, which is the DeFi risk-free rate, which is like, well, if I can earn 6% by just parking stablecoins in Aave, which is like considered a very low-risk strategy, then why am I going to take this more risky strategy, or why am I going to buy ETH? And as we see in traditional finance, like when the risk-free rate is high, it tends to drain liquidity out of risk assets because the hurdle is so much higher. And when that rate lowers, we start to see liquidity flowing into risk assets because now asset managers are saying, gosh, I'm not earning anything on my money. And LPs are saying, hey, what are you doing? You're not allocating my capital. Like, you're not actually making me any return. Go and buy some risky stocks so I can 10x or whatever. And I think there's something similar that can be seen in DeFi. So if we look at the borrow rate, this 7-day moving average of the Aave USDC borrow rate, which is the orange line here, the thing I noticed is that it lines up very well with the tops and bottoms of the market. And that's because it's, these rallies historically are driven by leverage, right? So as people start to get bullish on the market, they start to borrow against that ETH, they buy more ETH, they leverage up, everyone's leveraging up, that's increasing the borrow rate. And at the same time, because everyone's bullish, everyone wants risk asset exposure, they don't want stablecoin yield exposure. So there's also less liquidity in the lending markets, which further pushes the borrow rates up. And this kind of compounds until you just reach this unmaintainable position of like 16% borrow rates, where the longs are getting exhausted. People start taking profits. No one can maintain that level of leverage. And that's when the selling begins. And then all of this leverage just collapses, right? And that's what you see with, these peaks in the borrow rate lining up with the peaks in the asset prices and then going down to a trough. And usually that low borrow rate is kind of marking a bottom for the asset prices. That's the intuition anyway. And so one thing that was very different about this recent rally that I noticed is that the borrow rate is still very low. And then there might be
So just about to ask.
Yeah, there might be a few different things driving that. There's a couple of reasons. Like one of them is that there's a glut of stablecoin liquidity in the market, right? All of these institutions have come in big into stablecoins, so there's just a lot more supply, right, which is keeping the borrow rate low. There are also other instruments like yield trading tokens and also other strategies that may also be contributing to the low borrow rate. But part of the thinking here was that this might imply that the rally has much further to go because the leverage hasn't even really kicked in yet, at least on the borrowing markets, right? I mean, it may just be that leverage has migrated to the perp markets, although we would expect to see some relation between them there. So to cook up this DeFi heat index, what I did was to look historically at the relationship between the price of ETH and this USDC borrow rate on Aave and see, well, given the historical relationship, where would we expect the borrow rate to be now? And then to say, all right, well, if the borrow rate is currently below where we would expect it to be based on its history, we can say maybe the market is cool. It's not over leveraged, right? And we're not at imminent collapse, and maybe we have a lot further to go, as opposed to when the borrow rate is above expectation that the market is very hot, and this might be a bearish indicator. So I did run some back tests against this. I found that it's generally, it does, if you bought when it's cool and sold when it's hot, it is generally like a profitable strategy, but it doesn't outperform the market. It doesn't offer any significant benefit. But really, I just see this as like one more good indicator to look at for understanding on a big picture level where we are at in the market cycle. And it's something I'll be watching closely to see, do I think that we're reaching a top?
So this chart seems to cut off around September. What has been the update since September through now?
It's still quite low. Well, I would maybe we can put this out as a dashboard, so you don't need to ask me that. Maybe I can just direct you to a live chart. That would be better.
Yeah. You're like, let me Google that for you.
Yeah, as Alex said, this time will be different. This time is different. That's what this is showing. We don't need to speculate. We can see it is different.
It might well catch up. So if it does catch up, then that means bullish times ahead. So that's we'll hope for that. All right, good stuff. How much longer? I keep thinking that you have to run to catch your flight. Have you just missed it? You're just going to geek out about DeFi all day?
I'm good. Yeah, don't worry. Like I'll miss my flight. It's fine. No, I can keep going until the end of the hour.
Oh no, that's fine. It's fine. I think we're probably in good shape unless there's anything else you want to point to.
No. Again, yeah. I'll just say keep following our research. Stay tuned.
I like this chart here because it reminds me of the strong men create weak times, weak men create that whole meme.
Yeah, this is like degens create credit risk.
No, it's pretty cool. That's pretty cool, but very disappointing to see that it's going to get wrecked by the infusion of stable coins. We didn't think that TradFi coming in was going to have such negative consequences.
No, I don't think it's negative if borrow rates are low. Like ultimately, we want these markets to scale, right? Having low credit is great for the whole market. It means that we can leverage up on cheap money, right?
Okay, all right, fair point. Well, I was going to take a few minutes just to go through the important headlines and the results of the Squid Pass and some similar stuff. So feel free to stick around. So ordinarily we just go through and rip through all the top stories from the past week, but this was way more interesting. So I'm glad you did this. But I did want to highlight one, which was the top performing story of this past week was this. Best yields, one-click teleportation, grow your money stack. And you might be saying, well, what is that? Well, if you did when it was up and can still do now, click on this Squid Pass. That was the winner of the Squid Pass. And maybe that's evidence that the Squid Pass is effective, or maybe it was just a really cool site. I'm not sure which one. This was the winner of last week's Squid Pass, Wootcake, who's also like very frequently a top contributor to Leviathan News. Actually basically just vibe coded this app himself, and this app is a pretty cool one. We're just gonna pop it open and show what it looks like. So let's see this for like CBBTC. Why not? Since we've been talking a lot about Bitcoin.
I like their comment that this is giving them sushi and yams vibes.
Oh, very much so. Very much so, right?
If anyone knows what it means to brine a pickle, then you're definitely a DeFi OG.
See, I'm not sure being a DeFi OG is like even a good thing, because it was like the only cycle where like people mass joined and didn't make that much money. Like every previous cycle, you know, they already retired to their yachts. Anyone who was a DeFi OG, like I thought was doing much more interesting stuff and hasn't really quite been rewarded for it.
It means that you've got severe PTSD.
But yeah, you can see off on the screen here. This is the DeFi Garden, just best yields for the token that I typed in. So you could do this by lending markets, staking markets, LP DEX markets. You could filter it by if it's popular, LP, high APYs. It's looking for 3,000 results here, and you could, if you want, you can get the results in Korean. So like, what's not to like about this? This was entirely vibe coded by Wootcake, so check it out. Give them feedback. You know, easy to get in touch with. But it's not going to be the same Squid Pass next week, because the Squid Pass next week, while we were talking, was 16969 squid was the final amount, about $100 to purchase this. And we think it's Cogsy that won it, so it'll probably be AIs, could be Llamas. We'll find out soon, but stay tuned, and you could see that the Squid Pass drove good numbers. Another big story that I wanted to point out, which you might have seen it, the Squill Drop Season 3 is live. So Squill is the governance token for the Open Stablecoin Index, which tracks a basket of 10 leading decentralized stablecoins. It's the Squill governors who decide what goes in it. There's a fixed supply of 10 million Squill that's been given out in a series of airdrops. The Season 3 Squill Drop came out, representing 2 million. Squill, it went to Llama lockers, so very notable crowd. Might be some llamas watching right now. DeFi Llama subscribers, the Open Stablecoin Index community, specifically people who are already Squill governors or people who minted the Open Stablecoin Index, Gear governors, and Lobster DAO NFT holders. So if you missed that, definitely check that out. There might be some Squill waiting for you from this, or even past 2 rounds also still happen to be open. So if you past 2 rounds rewarded Leviathan News listeners, as well as people who were like in a lot of DeFi protocols. So it's worth checking all the 3 airdrop contracts and seeing if you got any Squill sitting in there. I know, Joe, you've been doing a lot of work around the Open Stablecoin Index universe. Anything you want to add in about this?
It's a very interesting project, in my opinion, and some big brain governors in there. Lots of good ideas being thrown around. I think they've done this airdrop pretty smart way, like trying to get distribution in some very good communities, right, and give back to some staples of DeFi. Yeah, it's just a very interesting project, I think, because it generates discussion around all of these different stablecoin networks, right, which are arguably the next big thing. So.
Yeah, it's kind of interesting because we've seen that TradFi stablecoins has very clearly been a powerful narrative, and we haven't yet seen that necessarily like rise the boat of the decentralized stablecoins. But I still pretty firmly believe that it is a fairly symbiotic relationship, and that the rise in TradFi stablecoins is going to redound to the benefit of DeFi stablecoins. I'm curious to hear about your thoughts on that topic, if you have any.
Well, yeah, I have an interesting thesis on this, which we can tie it back to some of my earlier comments about rates. And one of my spicy takes on this is that a lower interest rate environment from the central bank is a bullish catalyst for decentralized crypto-backed stablecoins. And the reason is that these are uncorrelated sources of yield. So the centralized stablecoins are basically taking your deposits and buying treasury bills with them and earning some spread on that. But as the central bank interest rates lower, the profitability of that strategy will decrease. Whereas DeFi stablecoins that are crypto-backed, like Curve USD, there's an inverse relationship. They are backed by people leveraging crypto. And as we said before, when TradFi risk-free rate comes down, liquidity tends to flow into risk assets. So we might assume that we start to see, more people chasing leverage, right? That means more people depositing collateral, borrowing more Curve USD or what have you, right? And as we saw with the Aave rate, as that leverage increases, the borrow rate increases, and that's where these protocols are going to make their fees. So I think there is this inverse relationship between the financial model of centralized and decentralized stablecoins, and it's quite bullish. And also for asset allocators, I think it's really like an interesting space to get into, because for these like relatively low risk strategies that like big money market based funds would be interested in, they want several uncorrelated sources of yield. So, okay, I want my 6%, but I don't want my 6% all concentrated in the treasury bill market. Maybe I want some of my 6% coming from the Aave USDC rate.
Interesting. Yeah. I mean, it makes perfect sense to me, because DeFi summer took off in the low interest rate environment. So why wouldn't it be the case that if interest rates do go down, DeFi picks up?
Yep, we need Powell to pump it.
One other thing while we're on the subject of the Open Stablecoin Index. So the way that the Open Stablecoin Index works is that it rebalances quarterly. At the moment, it's by a vote of VL Squill holders. So VL Squill holders get to decide what goes in the basket. Although there has been some talk about this is a V1 version of the methodology. There needs to be a lot of work done to try and tweak this methodology as it evolves, because you don't want it just to be necessarily a vote of the DAO. You want there to be some more strict parameters so that this can actually be a representative index. Otherwise, if it's a popularity contest, then you might get fart coin or Trump coin in there and things like that. But that being said, there is the regenesis going on right now, which VL Squill holders get the opportunity to steer. So we've actually seen some protocols already make some purchases of Squill, but presumably to vote for themselves. And we've seen some applications. Frankencoin's been in the comment section here on this RFC. We've seen Resupply looking to join the basket, but it is a fixed basket at 10, which means if these do join, or if Maple, which applied last round, if we see some of them in the basket, that also means some are going to exit the basket. So do you have a preference about coins you think belong in the basket or should be in there, or criteria for how coins should be evaluated to be in the basket?
I've made a suggestion that they should change this process so that rather than it being a vote on which stable coins are in this rebalance, that instead the voting is more on parameters. And then the parameters would determine at rebalance time what gets added. So therefore, like, the governance is not a beauty contest about which stablecoin or stablecoin network I personally prefer. And also, it's less open to said stablecoin project bribing me and saying vote for me. And we'll focus people more on, like, what is a good, sustainable methodology for this index, and then just leave it up to what the metrics say at that point in time to actually do the rebalance, right? And that as well as kind of voting on the parameters, voting on whitelisting certain projects to be considered when that rebalance happens. The reason why I think this is a better approach is just that I'm kind of a governance minimalist. It's actually one of the things I like about the way that some DAOs like Curve or Convex operate is, although they hold a lot of votes, I think Curve is one of the most active DAOs in terms of total number of votes raised. The content of those votes is very constrained. It's usually like, let's tweak this A parameter, right? In fact, the votes that we've seen recently are, have less precedence, like these big changes, big business deals, DAO-to-DAO business deals. That's actually not the norm.
Just mint $1 billion out of thin air, right?
Yeah. The norm is like, oh no, we're going to add a gauge on this thing, or we're going to vote, what proportion of emissions it receives. So I quite like the idea that you fix the scope of governance voting onto certain parameters, and that the governors then just tweak those parameters rather than like an open-ended governance. I think earlier days of Maker DAO were more like that, where it's like, well, we can vote on anything, and it's just an open canvas. And I think then it ends up being like individual people can end up having more sway, based on their pull power, let's say. So I think that would be a good direction I would suggest for the methodology. And therefore, I'm not going to endorse one particular stablecoin project on this stream.
No, fair enough. No, I think it makes sense. And I think that, I think that what's really nice about that, I don't know if it's nice about it, but like if you're just doing it in a strictly numerical way, you can run some back tests and say, it might be a philosophical decision, but like you might say like, well, why don't we just go ahead and favor the like whatever configuration of parameters seems to make Squill the most money, right?
Exactly. I'm a data guy, right? So let's make data-driven decisions, on an empirical basis. However, the way to make Squill money may also be, pay me, bribe me, then maybe I'll vote for you. Right? So that's also interesting. Is like, is the money for Squill actually from taking fees on a good performing index, or is it from taking bribes from people who want us to buy lots of their coin? And maybe there's some happy medium between the two.
It might be. And what's funny is if you see that, then it might end up being that like the big protocols get kicked out because they just don't care. And you get like a basket of 10 smaller upstart protocols that are just paying for exposure. At any rate, if you're interested in this topic, I would encourage people to check out Joe and I were on a space here on X. I should say here on X. Some of you are watching on YouTube, but this was 2 weeks ago. OXJMG hosted this. basically talking about a lot of these things. And if you're interested in the subject in general, find the open secret admirers chat. Just past 200 people who are interested in stablecoin networks. As Joe mentioned, just huge gigabrains in there, like really interesting chat and geeking out about stablecoins, as well as just these topics, because it's probably about a month away from when we actually get this vote underway, maybe sooner. And we will see what the basket looks like for the upcoming 3 months. One other quick story about DAOs, since you talked about good DAO governance, and that is just relevant to Leviathan news. Let's get this. It's not sharing screen here. It should. Every month at Leviathan News, we airdrop our token, the Squid token, to interested parties, and the Squid drop season is live. So if you have been enjoying anything Leviathan News has been doing, the time is now. The vote just went live this morning, and you can vote on which the particular categories you think have best been adding value to Leviathan. It'll wrap up next week on Friday during the live stream. So next Friday during the live stream we will watch. But go ahead and vote and see how you want to direct the Squid emission among the various aspects of auctions. The social features, as well as 4 live streams. We've had 4 really high quality live streams this month. This one, which is bringing up the rear of the quality.
Sorry, Curve Cut.
I just cut out, didn't I?
Sorry about that. I just lost you for a second. Yeah, I was just going to encourage everyone to. You can hear me all right now?
Anyone able to hear me?
Yes, I can hear you. I can hear you. I've got your audio.
Hello.
Hello?
Hey.
Yeah,
I'm back, like I never left.
That's good. You can hear me okay?
I could hear you just fine. What did I miss, if anything?
I was just going to go and encourage everyone to go and vote to send me Squid emissions, please. I think I'm adding value here.
You are actually so if you want to reward Joe in particular, you should vote on the category for James's live stream, because I believe that James gave about a quarter of the emissions in the Open Stablecoin Index to you. Let me get that. Let me get that sheet open, because it was pretty interesting to see. And then this month, of course, for being on the Llama party, you'll get in next month's vote. You'll be getting emissions for being part of this. So.
Oh gosh, I've got tokens coming out of my ears.
I know. What are you gonna do with all these tokens here?
Absolutely nothing. Same thing I do with all tokens, right? Just watch them. They're just like
all right.
They're just mementos, souvenirs for me at this point.
I forgot you're also a key player in the auctions, because I think maybe it was the Squill auctions you were taking part in. But you were 7th this past month.
May have done. I've never won one. Someone please just give me a chance. So.
Despite not winning, you still participated enough, so the participation trophy might end up being even better.
Oh, excellent. Yeah, but, it's the taking part that counts, guys. That's what we've learned about airdrop.
Yeah. But the right before I cut out, the thing I wanted to highlight is that social category is one of the best ways if you want to earn comments around Leviathan, is just go and leave comments on the articles, and I promise that we read them. Because I wanted to highlight this one comment in particular because it made me laugh so hard. I'm going to go ahead and read this on stream here. So this is on one of my Llama parties from last week, where Milkmaster7 made me fall out of my chair laughing. He said, and I quote, Why does dude look like he's from some small town local news anchor hoping to make a big news score and get to New York where he will make it? Ha ha. Sorry, he just has that look on him.
I think you look like you've already made it.
Well, it's particularly funny because I spent like a decade of my life in New York already, so I've already been in New York. But all I have to say is we'll have that and much more right after sports. Oh my gosh, I thought that
What
was
is the
so
sports?
fun.
It's hamster racing. Is that the sports we do in crypto?
Oh gosh, I don't even follow sports. I'm the wrong person to ask. That's why you have a dedicated sportscaster, I guess. All right, Joe, really appreciate you doing this. I believe that we have another open stablecoin index calls coming up soon. So hopefully we'll get a chance to geek out more about open stablecoin index. I'm seeing the chat is... oh, yeah, Alice is pointing out that if you saw the pants, you wouldn't say that I looked... you'd say... you would have some serious questions about my life choices if I was stood up. So let's hope there's not an earthquake.
That's how you would know he's made it. In closing, by the way, I'll just like hint some alpha is that everyone should follow the in Pangaea account. We might be dropping something very exciting soon, and I would suggest that anyone interested should go and enter our Discord. There may be something very interesting dropping there very soon.
All right. You don't need to ask me twice. I'm going to go ahead and do that right now.
I won't say any more than that, but go and join the Discord and you might find something cool there very soon.
All right. I will be there. I'll probably have to... I'm at my Discord limit, so I'll probably have to leave some other Discord to do it, but I'm sure it'll be worthwhile. Joe, really appreciate you.
This is the Discord index, right? We're doing the Q4 rebalance of the Discord index.
Yeah, I need the top 10 as voted on by holders so I can just rebalance and be in the 10 Discords that are good at any given time.
Well, Pangaea's definitely got to be in there. You'll find alpha there first. By the way, like I like to, you've seen me posting cool charts and stuff, nice data on Twitter. Usually that stuff will get dropped on our Discord first. If you want to be the first to know, go and join the Pangaea Discord.
All right, there we go. I'm joined. Where's my tokens?
Soon.
All right, Joe, really appreciate you coming here to talk about your research. Anytime you got research, like feel free to stop by. It'd be great to have you talk through it because I think you do a really good job of going through kind of like really complex stuff, distilling it down so that people who are not very smart like me can understand it. Going through all the implications, like all of your writing covers all the questions that I would have about it. So, just really phenomenal job in like distilling this complex on-chain data into something comprehensible and actionable. So,
thank you.
Anytime you want to come back.
A great privilege to take my place on this esteemed platform. So thank you for this honor.
Anytime. It's open invite, so as you see, I could drop the link in the chat. But don't feel like you feel like you have a place of honor anytime you like to join us.
Thank you.
All right, friends, it has been another successful Llama party. 10-10-25 for the win. We hope that you guys are up to big things for the weekend. Make sure to catch up on all the live streams that we mentioned to entertain you through the weekend, and we'll be back, of course. All of DeFi will be back throughout the weekend and next week to entertain you all. Stay safe, friends.